So in today's video, I'm going to talk about the S&P 500, which is used, probably most frequently to gauge the overall stock market. When people say where they're talking about the stock market, a lot of times they're usually talking about the S&P 500, sometimes the Dow Jones, but I'd say the S&P 500 more so today. But what I'm going to be looking at is I'm going to be taking some information from fast graphs, which I use a lot to analyze individual stocks, and I'm going to use that information that it has on earnings, and I'm going to use it to look at the S&P 500 in the similar way that I would look at individual stocks. So looking at the earnings, looking at the valuation based on its PE ratio, where it's traded historically based on PE ratio, and its dividend yield. I think this video will highlight some things about just long-term and short-term investing in general, and give you an idea of when to be in the market with, what type of money to be in the market with, and how to think of the stock market based on your overall time horizon. So I'm going to look at the S&P 500 on the monthly chart, which is a chart I don't frequently use, but it's pretty interesting to look at. The information goes back, pretty far here on TradingView. This dotted information, I don't know if that's because it's not as accurate or something, but you can see the Great Depression, that stock market bubble. But you can see overall, any large dip in the stock market is basically long-term, almost always a really great buying opportunity. The problem is that these dips look kind of small on this monthly chart, but they can take years for you to recoup losses, from the top. So for example, at the top of the NASDAQ bubble, which definitely affected the S&P 500 as well, you can see that it took, I think, about 14 years. So this is March 2013. So about 13 years to recoup from the top of this market. But if you're long-term investing, you're dollar cost averaging the whole time you're down here, you really decrease that payback time, although you did at the financial crisis here as well. So perhaps a bad example, but the majority of the time, it's almost always a great buying opportunity. So with that being said, we actually find ourselves in a red candle this month. So it's probably good to talk about this correction and what could some possible downside targets and where we could go from here with the election and all the other uncertainties that are coming up in the winter. So going into fast graphs, we'll take a look at the all time frame, and just looking at the S&P 500, you can see that, like a lot of the stocks that we look at, the earnings really does a pretty good job of forecasting at least some sort of, correlation with where the price is going. So the price definitely will track above the earnings, this blue line here, which shows the average PE ratio over this whole time frame, which is 17.5. And you can see times where we were below this were all really good long-term buying opportunities in the S&P 500. So today we were trading at 33.57, and you can see that we are way above the blue line on the S&P 500. So we can talk about that because it's important to understand what this graph is showing us. And this is based on earnings estimates. So this is forecasting a negative 19% earnings in the S&P 500 by the end of the year. So that shows that target price at a 17.5 PE, would be 2,286. So a good ways off from where we are today. And you can also see where it would forecast us to be in 1 year and 2 years. For individual stocks and things I want to hold, for a year, at least a year, I typically look at the 5-year time frame. So this will be the time frame that I'll kind of translate data over into TradingView so you can see how that looks. And I think that gives us a little bit better idea. We'll be able to zoom out a lot more than we can in fast graphs, but the data in fast graphs is really important. So the first thing we'll see is we've traded at an 18.66 PE ratio, and right now we're trading at a 24.09, right? So that's because of this really low earnings and the high price that we have right now. So we've had this huge run. You can see we dipped below this line. So we dipped down to a 16.78 PE ratio. That was in the lows in March. We'll talk about that PE ratio and see where that puts us today. But as of now, we're sitting at this 24.09. So if I look at the aggregate score for the S&P 500, like I do for lots of other stocks, you'll see that we get a dividend yield of 1.79%, an adjusted operating earnings growth rate of 7.54%, and then we get overvalued. We get 22.54%, negative 22.54% as our value in the valuation yield. This is going to give us a negative aggregate score of negative 13.21%. So we've looked at a couple other stocks that are definitely positive, and I think that's a good takeaway just from the one takeaway from this analysis is that although the market might be a little overvalued right now, there might be some value. It is important to know that a lot of the times the overall market will drag down other assets. So it's good to just kind of have an eye on certain things, and on days when the market is down, start to buy names that are on your watch list. So we'll get to what I really want to show you on TradingView, where I'm going to pull the data over from Fast Graphs. So you can see we've had this, our big drop here, about a little over 30%, and then we've ran up to all-time highs. So just, kind of extending this big kind of megaphone structure in the chart. And then recently we've had this pullback, which as of Friday, we're down about 7.5% from the all-time highs. So where do some of the targets from Fast Graphs that we looked at just a second ago show up when we look at them on TradingView? The first one that I want to look at is if we took that 5-year average PE and we took that 18.66 and we took the earnings and we applied it. So the earnings were 130, and so we apply that, we're going to get 24.31 as our target. So that's close to the lows in March. And that's based on that drop in earnings and also the drop in valuation back down to that 5-year PE ratio. And so you can see that the recent drop brought us down to that 16 PE ratio, which really isn't too far off of, where we've been in this historical time period, which is just looking back the last 3 years. And that's because we were so extended in February right before all of that volatility. If we extend this out based on the analyst earnings, what you'll see is that it'll take us about 2 years to get to where that normal PE ratio would sort of be justified based on the forecast. So this is all based on analyst forecasts. We'll talk about what some of the earnings beats might look like. And that's basically what would need to happen in order to kind of justify current valuation and price if we use these historic multiples. Just for comparison, look at the PE that we had during the lows in the financial crisis, which was 10.33. That's a 60% drop from where we are today. And then you can see the sort of recovery. The other one that might be a little bit realistic, but also kind of high is the PE that we had in the early 2000s, which was 21.772. So if we were to have that PE, we'd have right around 28.30. And then you can see a recovery and new all-time highs. What would be the forecast for next year? Just to kind of understand where we are today, basically calculated where a flat earnings valuation would be at, and that's at about 35.18. So that's actually above where we are today. Where we are today is somewhere around, I think it was about negative 6%. And then I was sort of thinking about it, the potential of second wave of volatility from the virus. And when we had that initial drop from that back in March, that got us to a PE of 16.78. So again, that's right around retesting the lows. So this area looks like it has a lot of almost fundamental support, I guess you could call it. As well as some technical support. If we do, continue to drop, that would be, hopefully a really strong region. I don't see us going that low, but who knows? The last thing I added here was, let's say we had that earnings beat, and then we also have the forecasted earnings that brings us, out to, some pretty positive growth, as of now and into, the coming years. So I hope that this video was helpful, just to give you an idea of, where the market could possibly go, where it's been before in terms of valuation, and what the current pricing kind of means or implies, right? So we have this forecasted negative 19% earnings. We're at a pretty high historical PE, and again, this is just the S&P 500, so that's made up of lots of different individual stocks, and there's still a lot of good value out there, in some other names. So make sure you check out my other videos, and I've got some of those names in some of those videos. So thanks for watching. If you enjoyed this content, make sure you subscribe to the channel.